Orlando was the poster child of Florida's unstoppable housing boom. Home prices doubled in 2 years, and thousands moved in every week. But just as the governor was boasting about paradise, disaster struck. Insurance premiums soared over $6,000, deals collapsed overnight, and Hurricane Erin sent buyers running. Now, in a desperate bid to stop the bleeding, the governor of Florida panics and proposes abolishing property taxes entirely. Why did paradise unravel so fast? And can any politician save a city suddenly drowning in its own success? What happens next will change everything you thought you knew about Florida's real estate dream. Sun, palm trees, and a line of moving vans stretching up I-4. In 2021 and 2022, Orlando became the landing pad for America's restless, remote workers, retirees, families chasing a fresh start. Nearly 1,500 new residents arrived each week, trading cramped apartments and high taxes for the promise of space and sunshine. School districts scrambled to hire teachers. U-Haul ran out of trucks, and every neighborhood Facebook group buzzed with posts from newcomers asking about the best grocery stores and local doctors. The numbers were staggering. Florida's population topped 22 million, with Orlando ranked among the fastest-growing metros in the country. Rental homes vanished within hours, and bidding wars for starter houses became routine. For a cashier at Disney or a nurse at Advent Health, the math was punishing. Median home prices shot past $400,000, while local wages lagged behind. By late 2022, housing costs were swallowing more than 45% of the average household's income, well above the safety line. Every week brought more out-of-state plates and new construction crews. Developers raced to pour foundations in Lake Nona and Winter Garden, but demand kept outpacing supply. The dream was simple: buy now or be priced out forever. For families like the Nguyen's, who left Seattle in search of affordability, the reality was sticker shock. Insurance quotes topping $6,000, taxes climbing, and the starter home they'd hoped for now out of reach. Orlando's growth engine ran hot on outside money and migration. Local buyers found themselves boxed out, while sellers watched open houses turn into auctions. The city's allure was undeniable, but the seeds of imbalance had already been planted. The question was never how high prices could go, but how long the boom could last when paychecks couldn't keep up. Wall Street's arrival in Orlando was anything but subtle. In 2021, Blackstone and other institutional giants began snapping up single-family homes by the hundreds, often outbidding families before a single for-sale sign hit the lawn. Entire subdivisions in Lake Nona and Kissimmee flipped overnight from owner-occupied to rental communities, their streets lined with identical white SUVs and property management vans. Blackstone's Florida portfolio ballooned past 12,000 homes statewide by mid-2022, with Orange and Osceola counties at the heart of the spree. Developers saw the money and shifted gears. Lennar and Pulte poured record numbers of slabs, launching new phases in Horizon West and Winter Garden, sometimes selling entire blocks to funds before the drywall even went up. In 2022 alone, Orlando area builders started more than 28,000 new homes, a figure not seen since the last housing bubble. Local brokers joked about mystery buyers wiring cash from Manhattan or Singapore, sight unseen, then raising rents 20% in a single lease cycle. The frenzy warped the market. Bidding wars weren't just for families anymore. Now, it was hedge funds versus teacher couples, with the funds waiving appraisal waivers and promising 10-day closes. By fall 2022, nearly 1 in 5 Orlando home purchases involved an institutional or out-of-state investor. For the Nguyens, and thousands like them, the starter home became a moving target, priced higher each week by offers from faceless LLCs. Builders, flush with cash, ramped up construction but funneled inventory straight into the rental pipeline, deepening the squeeze for buyers on the ground. Behind the scenes, spreadsheets replaced neighborhood barbecues. Investors calculated yields, not school zones. The promise of fast money fueled ever bigger bets, with some funds buying homes in bulk, sight unseen, and leasing them back to the very newcomers who'd hoped to buy. The boom, once powered by families and retirees, now ran on algorithms and quarterly targets. For Orlando, paradise was being bought up, one portfolio at a time. MLS dashboards now tell a new story, one of stasis, not surge. Orlando's median home price sits at $450,000, a figure that once looked like a finish line, but now feels more like a ceiling. The bidding wars and overnight price jumps of 2021 are gone. Instead, listings linger, and the city's for-sale inventory has ballooned 35% in just 12 months, topping 11,000 homes by summer 2025. Subdivisions in Winter Garden and Lake Nona, once stripped bare by investors, now display clusters of yard signs, some faded, some fresh, all waiting for offers that rarely materialize. Market analysts point to the numbers. Nearly 1 in 3 Orlando listings now cuts its asking price before finding a buyer, compared to just over 1 in 5 nationwide. Homes that would have sparked a dozen showings in a weekend now sit for weeks, even months, as buyers weigh mounting costs and future risks. The days on market metric has ticked up to 36, a 12% jump from last year, and the gap between list and sale prices grows wider with each passing week. The supply glut has shifted leverage. Buyers, once forced to waive inspections and scramble for financing, now negotiate hard for concessions, closing credits, rate buydowns, even free appliances. Sellers, many of whom saw their neighbors cash out at the peak, face a stark choice: reduce the price or pull the listing and wait. Some have already walked away, taking their equity off the table rather than risk a fire sale. Behind the data, the mood is unmistakable. Agents talk about a market on pause, where uncertainty drives hesitation, and every new listing is a test of patience. The days of easy money are over. In Orlando, the question isn't how high prices will climb, but how long they can hold their ground with the floodwaters rising beneath them. Buyers are pulling the plug on deals at a pace Orlando hasn't seen since the last housing bust. Leonard Pulte and D.R. Horton report contract cancellation rates running as high as 27%, nearly double what builders considered normal just 2 years ago. In Lake Nona and Winter Garden, the phones ring off the hook, not with eager offers, but with nervous buyers asking how much they'll lose if they walk away. Some cite ballooning insurance quotes, others blame mortgage approvals that evaporate overnight. The result is the same: signatures vanish, and homes go back on the market before the paint has dried. Agents describe a new ritual: writing contracts in the morning, tearing them up by nightfall. One broker in zip code 32827 counted 7 deals lost in a single week, all after buyers balked at insurance bills north of $6,000 or lenders froze funding in the wake of Hurricane Aaron's threat. For every home that closes, 2 more seem to stall or fall apart, leaving sellers with empty rooms and rising anxiety. Listings now linger an average of 36 days, up 12% from last year. Yard signs cluster at the ends of cul-de-sacs, some sun-bleached from months of waiting. In subdivisions that once saw bidding wars, open houses now draw a trickle of cautious visitors, most with calculators in hand. The inventory pileup is visible everywhere. Over 11,000 homes for sale across Metro Orlando, a 35% jump in just 12 months. Builders/prices offer closing credits and throw in new appliances, but even steep incentives can't stop the tide of cancellations. For families who hope to settle by summer, the dream is slipping out of reach. One couple in Winter Park describes sleepless nights, watching insurance estimates climb by the week until their lender withdrew the pre-approval. Their story is echoed in court filings across Orange and Osceola counties, where distressed sales and auction notices are ticking up, often citing unaffordable carrying costs as the final straw. The human toll is measured in broken plans and mounting stress, as both sides of the closing table face a market that no longer plays by the old rules. Builders, caught between rising costs and vanishing buyers, are pausing new projects and offering steep discounts to keep contracts alive. The mood among agents is tense. Every showing is a test of nerves, every offer a question mark. In Orlando, the age of easy deals is over. Each failed contract leaves another home stranded, another family in limbo, and the city's confidence on even shakier ground. For the New Gwyn family in Avalon Park, the math is relentless. Their homeowner's insurance bill, once a manageable $2,800, now clocks in at $7,540, more than their property taxes and HOA fees combined. The premium alone eats up nearly 15% of their take-home pay. Across Orlando, stories like theirs are everywhere. Retirees in Conway, nurses in Winter Garden, teachers in Sanford, all face the same sticker shock. Premium notices arrive like clockwork, each one higher than the last. A typical policy now runs $6,800 to $8,200 a year in Orange and Osceola counties, compared to a national average just under $3,000. For many, insurance is no longer a line on the spreadsheet. It's the deal breaker. Monthly budgets buckle under the weight. Mortgage calculators that once factored in $200 for insurance now spit out numbers triple that. Some families pay more to insure their home than to pay property taxes, with annual tax bills ranging from $3,200 to $4,900 for the median house. The premium surge has wiped out savings plans and forced tough choices. Put off repairs, skip vacations, or pull kids from after-school programs. For first-time buyers, the news is even worse. Lenders won't approve a mortgage without proof of coverage, and quotes above $7,000 push many out of contention before they ever set foot in a house. Agents describe open houses where would-be buyers walk out shaking their heads, insurance estimates in hand. The dream of home ownership, once a birthright in Central Florida, now slips further away with every renewal notice. The sticker shock isn't limited to newcomers. Longtime residents, some with paid-off homes, find themselves forced to shop for coverage every year as carriers exit and rates spike. For the Nguyen's, the premium spike means less left over for everything else. For Orlando, it's a warning siren. Affordability isn't just about price anymore. It's about surviving the next bill. 3 insurance giants, United Property and Casualty, St. John's, and FedNat, collapsed in quick succession, leaving more than 400,000 Floridians scrambling for coverage. Each failure triggered a regulatory scramble and a wave of policy transfers. State regulators, pressed by headlines and mounting public anger, offered reassurances that the system could weather the storm. But behind closed doors, internal memos flagged chronic underfunding and warned that one bad season could wipe out reserves. With every carrier that failed or withdrew, Citizens Property Insurance Corporation swelled in size. By late 2024, Citizens covered 1.3 million homes, nearly 1 in 8, across Florida. Officials at Citizens described a mounting sense of unease. The company, built as a backstop for emergencies, now found itself carrying the weight of the state's riskiest properties. Its reserve fund, once a point of pride, looked increasingly thin against the scale of exposure. Regulators faced a dilemma. On one hand, they needed to keep premiums within reach for everyday families. On the other, actuarial tables showed that even a moderate hurricane could drain Citizens' reserves and trigger emergency assessments on every policyholder in Florida. In legislative hearings, state insurance officials acknowledged the risk. If Citizens ran dry, the cost would ripple across every homeowner, not just those enrolled in the program. For buyers, the exodus of private carriers turned insurance into a high-stakes gamble. Real estate agents fielded frantic calls from clients who'd lost coverage days before closing. Lenders, wary of insuring homes through Citizens, began tightening approval standards or demanding higher down payments. The illusion of stability faded. In Orlando, the question was no longer how to afford a home, but whether coverage would exist at all when the next storm threatened. The market's foundation, once propped up by dozens of private insurers, now rested on a single, overloaded safety net. Ocean temperatures off Florida's east coast climbed past 88 degrees in late August, setting the stage for a hurricane scare that would paralyze the Orlando housing market. Aaron's projected path shifted west, and by the time the National Hurricane Center's cone swept across central Florida, panic had already taken root. Meteorologists filled the airwaves with warnings, Category 4 winds, storm surge models, evacuation maps, traced in red. But for Orlando's buyers and sellers, the real damage arrived before a single drop of rain. Lenders hit pause on all closings inside the cone. Mortgage approvals froze in zip codes from Lake Nona to Winter Park, with banks refusing to fund deals until the threat passed. Insurance carriers, already battered by years of catastrophic losses, stopped writing new policies altogether. For buyers under contract, this was the nightmare scenario. No insurance, no loan, no way to close. In the space of 48 hours, hundreds of deals collapsed. Builders like Lenner and Pulte watched cancellation rates spike by the hour. Agents fielded panicked calls from clients desperate to know if their deposits were safe or if they'd be on the hook for a home that might not survive the week. In Avalon Park, a young couple tore up their contract after learning their insurance quote had jumped to $8,200, double what they'd budgeted. In Baldwin Park, a retired teacher described sleepless nights, watching her lender withdraw a pre-approval as Aaron's wind field ballooned to 500 miles wide. For every home that closed, 2 more fell apart, leaving sellers with empty rooms and rising anxiety. The MLS filled with relisted properties, some marked as back on market, just days after a pending sale. The numbers told the story. In the first week of Aaron's approach, contract cancellations in Orlando surged to nearly 30%, triple the typical rate for late summer. Builders slashed incentives, offering closing credits and free upgrades, but buyers were in retreat. Open houses emptied out, replaced by endless strings of text messages. Is the house still available? Can you hold my deposit? What happens if the roof goes? Behind closed doors, risk managers at banks and insurance companies pored over maps, calculating exposure. The private market's retreat forced even more buyers onto Citizens, the state's insurer of last resort, which itself had stopped accepting new applications in the highest risk zones. For families who had spent months searching, the dream of a new home vanished overnight, undone by a storm that never even made landfall. In Orlando, the lesson was clear. Climate risk isn't just a distant threat. It's the wild card that can freeze a market in a single news cycle, leaving confidence shattered and deals in ruins. The governor's press conference landed like a thunderclap in Tallahassee. Cameras rolled as Ron DeSantis stood at the podium, flanked by lawmakers and real estate donors, announcing a plan no one saw coming: the permanent elimination of property taxes in Florida. The headline was simple: $1,000 rebate checks for every homesteaded homeowner, immediate relief, and a promise to put the question of tax abolition on the 2026 ballot. The details, buried in draft legislation and budget memos, painted a messier picture. Property taxes fund between 35% and 60% of local government budgets, with schools relying on them for over 40% of their operating dollars. The amendment would replace those revenues with a $500,000 homestead exemption and cap annual assessment hikes at 15%. To pass, the proposal would need a 60% supermajority in the next general election, a hurdle no Florida tax amendment has cleared in a generation. In county offices from Orange to Osceola, the reaction was swift and furious. Tax collectors called emergency meetings, warning that the plan would blow billion-dollar holes in school and public safety budgets. At one session, the Orange County tax collector read aloud from internal emails: "If this passes, we're looking at mass teacher layoffs, fire station closures, and deferred road repairs. There is no backfill." Finance directors ran the numbers and found that even with the state's current surplus, covering the lost revenue would require either a massive sales tax hike or deep cuts to essential services. School superintendents drafted statements for parents, warning of program cuts and the risk of losing local control over funding. For supporters, the optics were irresistible. The rebate checks arrived in mailboxes just as insurance bills hit their peak, and social media filled with photos of smiling retirees and grateful homeowners. The governor's team blasted out talking points. Florida would become the most homeowner-friendly state in America, a magnet for new buyers and investors. In the week after the announcement, home builder stocks rallied and mortgage lenders reported a spike in pre-approvals. But fiscal watchdogs and policy analysts called the move reckless, warning that short-term relief masked long-term instability. Editorials in the Orlando Sentinel and Miami Herald accused DeSantis of political theater, a desperate bid to buy confidence while sidestepping the hard math of government finance. Behind closed doors, the governor's advisors traded urgent emails with donor groups and insurance lobbyists. Leaked memos revealed deep unease. "This is urgent but reckless," one deputy counsel wrote. "We're trading sustainable funding for a one-time sugar high." Legal teams flagged the risk of lawsuits from counties and public employee unions, who argued the amendment could violate state guarantees for education and public contracts. The ballot language, rushed through committee, faced immediate challenges over clarity and compliance with federal law. In the markets, the impact was immediate but uneven. Real estate stocks surged, but municipal bond prices slumped as investors braced for a wave of downgrades. County leaders warned that, without property tax revenue, credit ratings could collapse, driving up borrowing costs for everything from school construction to hurricane recovery. The $1,000 rebate, hailed by some as a lifeline, looked, to others, like a Band-Aid on a gaping wound. The question hanging over every meeting, every budget hearing, every kitchen table in Orlando: what happens when the rebate runs out and there's no money left for the basics? For now, the promise of tax freedom is everywhere. The cost and the reckoning are just beginning. Blackstone's retreat from Orlando began with a single, unremarkable listing in Lake Nona, a 3-bedroom, bought for $420,000 in 2021, now quietly offered at $345,000. Within weeks, the pattern was impossible to ignore. Dozens of homes across Orange and Osceola counties hit the market in waves, each one priced tens of thousands below its last sale. The spreadsheets told the story. Losses of $50,000, $80,000, sometimes $150,000 per property, willingly accepted just to get out. Internal memos circulated among asset managers, citing non-viable risk/reward profiles and insurance costs that had doubled in 2 years. One executive's note, later leaked, read simply, "Exposure exceeds upside. Liquidate Florida." For years, Blackstone and its peers had been the invisible hand behind Orlando's bidding wars, outmuscling families and reshaping entire neighborhoods. Now, their exit was anything but subtle. Local brokers fielded bulk offer requests, 10, 20 homes at once, each listing a reminder that the smart money was running for the exits. The sell-off rippled through the market. Appraisers began using fire sale comps from institutional portfolios, dragging down values for everyone else. Sellers who'd once dreamed of cashing out at the peak instead watched their equity evaporate as Wall Street's markdowns reset neighborhood expectations overnight. Behind closed doors, fund managers described a calculus that no longer worked. Insurance premiums topped $8,000 per year on many rentals, erasing margins. Rent growth had stalled, tenants were pushing back, and the specter of new taxes or regulations loomed after the governor's latest gambit. "We're not in the business of subsidizing risk," one manager told colleagues. The message landed with a thud. If Blackstone couldn't make the numbers work, what chance did individual landlords or new buyers have? In Orlando, confidence wasn't just shaken. It was leaving town, one portfolio at a time. In a quiet cul-de-sac in East Orlando, a pair of lawn chairs sits empty outside the Hernandez home. Their mortgage rate, once fixed at 3.2%, now sits on an adjustable schedule, resetting above 8% after a brief teaser period. The new monthly payment swallows half their income. With insurance premiums north of $7,800 and property taxes still due, the numbers no longer add up. Each week, Anna scans the mail for a miracle, but the only envelopes are bills and a notice from their lender. Payment overdue. Across Orange and Osceola counties, stories like theirs are multiplying. Court dockets show a 28% jump in foreclosure filings since last summer, with auctioneers busy every Friday, rattling off addresses in zip codes once considered immune to distress. Homes that were family sanctuaries just 2 years ago now sit vacant, grass knee-high, windows taped against the next storm. In 2025, foreclosure rates in select neighborhoods have climbed 20 to 40% above pre-pandemic averages, a number that stings in a city built on the promise of stability. For buyers, the math is brutal. With rates stuck above 8%, a median-priced Orlando home demands a $3,900 monthly outlay after taxes and insurance, out of reach for most working families. The buyer pool shrinks by the week. Agents report open houses where nobody shows, or where visitors leave after a single glance at the mortgage calculator. The few who qualify face a market where every extra dollar goes to insurance, not equity. On courthouse steps, auctioneers call out lots to small crowds. Mostly investors, hoping for a bargain. Rarely families. The cycle feeds on itself. Each foreclosure adds another listing, pushing prices lower, eroding confidence. For the Hernandezes, the dream was simple: a backyard for their kids, a shot at stability. Now, like so many in Orlando, they wait for a knock at the door, wondering if the next buyer will be someone looking for a home or just another name on a spreadsheet. Market forecasters now warn that Orlando's housing correction is far from over. Most expect home values to drop another 10 to 15% by late 2026, especially in neighborhoods where prices soared fastest during the boom. The data points to a new reality. Even as population growth continues, the people arriving are not the same buyers who once drove the frenzy. Cash offers now dominate the market, outnumbering first-time buyers armed with mortgages. In some zip codes, more than half of all sales close without financing, a stark reversal from the days when families lined up for starter homes. Demographic shifts are reshaping demand. Retirees and remote workers still trickle in, but many local families have been priced out or sidelined by insurance hurdles and lending standards that grow stricter by the month. Analysts at Moody's and Redfin note that the buyer pool is shrinking, hollowed out by affordability gaps and shaken confidence. The dream of homeownership, once the backbone of Central Florida's growth story, now feels increasingly out of reach for those without deep pockets or outside wealth. Uncertainty hangs over every forecast. Some experts see a slow grind downward, values adjusting quarter by quarter, listings lingering, and sellers forced to accept less. Others warn of aftershocks if another hurricane season brings fresh losses, or if new insurance reforms fail to stick. For now, the only certainty is volatility. In Orlando, the promise of easy equity and Sunbelt security has given way to a waiting game, where every open house and price cut raises the same question: how much further is there to fall, and who will be left to buy when the dust finally settles? In 2025, Orlando's housing market saw inventory jump by over 35%, with home prices stalling after doubling just 3 years earlier. Insurance premiums now top $7,500, more than twice the national average, forcing 1.3 million Floridians onto the state-run Citizens Plan. As Hurricane Erin approached, mortgage deals froze, and the state government responded with a proposed end to property taxes, a move that critics called risky and untested. Meanwhile, Blackstone's decision to sell at $50,000 to $150,000 losses per home signaled eroding confidence from major investors. Foreclosure rates are now 20 to 40% above pre-pandemic levels, and analysts project further price declines of 10 to 15%. Yet the long-term impact of the governor's tax proposal and the future stability of Florida's insurance market remain unresolved. What is clear: the combination of soaring costs, climate threats, and political uncertainty has turned Orlando's housing boom into a cautionary tale for the nation.